In this session, we continue with exits on trend days, but now we're going to be talking about how to exit the setups that you use to get on board the trend during the day after it's confirmed. We've talked about when you get in early and have that core position that you hold. Now we're going to be talking about the other trades you can put on during the day that are independent of the core position. So let's jump into the charts and take a look at that. So here, let me make it simple for you. The way you exit the setups that you're taking during the trend day, now you're riding the trend. If you had gotten on board early, you're basically entering a new independent trade with its own stop, with its own position sizing, independent of the one you already have on. Okay, just to be clear. And you can exit that one and it doesn't affect the original trade. You could take a loss on that one. Let's say you had gone short here for an extra trade and this thing shot up and you didn't expect that. You take a loss on that independent trade, but you might still be short from the morning here. So to make it simple for these setups, you really want to exit these based on the same exit rules that you learned before about the fade setups. Okay? You want to basically exit either at a normal rotation, either at the next support resistance zone, at some kind of exhaustion, or even at a divergence in the right context. And let me give you an example. Let's say you entered short here. So let's zoom into that. All right, here we are. And let's say you had seen that this is now confirming as a trend day. It popped back up. You saw this range expansion in this bar. It hit a tick extreme at the same time. And you felt, okay, this is a good short. And your stop maybe is somewhere up here. So it's a 2.5 to 3 point stop. Okay, just beyond this little volume congestion right here. And it's a volatility stop in itself just to keep you out of the noise. So you have a short on, and we're just going to say it's about a 3 point stop. Okay, now what would be your profit exit? Would you scale out? Would you, all those type of things? Well, first, let me just give you a general principle here, and it's the fact that when you're in trend days, the conviction overall is pretty high. And if you're timing your entries pretty well, you're waiting for those ideal times to fade the counter trend move, the odds are quite high that these will work. And because of that, you really don't need large reward to risk ratios on these. You remember the continuum of reward to risk. You either have high reward to risk and low accuracy, or high accuracy and low reward to risk. Well, in this case, if you're timing these right, your accuracy is going to be pretty good on them, especially if your stops are wide enough to get you out of the noise, right? And if you know you've likely caught the extreme of a reaction, I mean, this one's a pretty small reaction, so you might not have thought of that. But given the context, this is all you're likely to get. But with experience, you'll start to notice when you're likely catching the extreme of a reaction. When, let's assume this thing had come up and hit this little resistance zone, this mini volume congestion along with the previous low, which now are likely resistance, and this thing is really expanding up and we're hitting a tick extreme. That's likely the high right there for this reaction, and you're likely to go make new lows pretty quickly. And so if you've hit it there and you have a 2 or 3 point stop, let's assume a 3 point stop here, it's not wrong per se if you only had a 1-to-1 reward to risk. Of course, in this instance, by default, because it's a trend day, you should likely have more than a 1-to-1, because the odds are this thing's going to come back and break the lows and go make new lows. So you should easily have more than 1-to-1. But in principle, it wouldn't be wrong to take a 1-to-1. For instance, what will often happen in these days, you'll pop up like this, you'll come back down, you'll go down, and then you're going to come back and pop up again and have the same extreme because you build a balance. And we've seen, I've shown already a couple examples where you build a midday balance. Well, if you were getting short on the next extreme up to test the previous high of the balance, it wouldn't be wrong if you had a 1-to-1 reward to risk back down to the bottom of the balance only. Those still pretty decent odds that you're going to get that kind of trade. And midday, those will often be great trades to make. you'll fade the high of the previous balance and you'll take profits at a lower one. And I'm going to show you one just to be sure. But in this instance, if you got in short here, I remember on this particular day we had support drawn somewhere around 95 or so. Well, you could take your profit right at 95. Short here at 400, 400.5, and you take it at 95. You got 5 or so points of profit for 3 points of risk, and you have, about 1.65 reward to risk, which is very good on these types of days because the accuracy is usually so high. Okay, if there was no support here, maybe you would have waited to have this exhaustion where you get this push down and there was a tick extreme or something. Then you would take your profit there. The reason why we don't hold these for huge moves is because we're entering at places where if this were to come back and take it out, it wouldn't invalidate the whole trend. Okay, and so you don't want to have that reverse and you lose your profit and turn into a loss when you could have taken a nice high odds winner. Sometimes you can hold, like if there was no support at 95 and you wanted to just wait to see a gush down like this bar. Let's look at how that would have looked like in real time. Okay, here it is. If you had gotten short here and you were holding, and then bam, you got this big bar after we've been going straight down for almost 10 points with no bounce. Those are usually times when you're going to get a bounce. And if you've gotten short here, riding the trend, this would be a nice profit to take. You've gotten up close to 9 points on a 3-point trade. That's 3-1. That's awesome. Now, would you scale out? Well, it really depends on the setup itself. Okay, if you enter a setup where you feel like you've really hit the extreme, that means your conviction is pretty high that you've reached the extreme of how much price is going to move currently. Then, if you feel really good about the setup, just let it ride. If, on the other hand, you've hit an extreme and you think, well, we're surely likely to get a decent reaction down, but I don't know if this thing's going to go back up and put in a bigger retracement, then fine. You get in here, you take half off at 1-to-1, and then if it does come back here, at least you won't be at a loss. All right, so it just depends on the setup. Just look back at the other videos where we discussed the exit techniques and the effective rules and just use it in the same way. If you feel high conviction that you've gotten in now at a zone, at an area that's going to be the extreme of the move, then don't scale out and take a 2-to-1, 3-to-1 reward to risk. That's great, especially if you're adding it to an already big winner that you have in your core position. If you're getting in because it's an extreme, but you think we could be putting in a bigger retracement, maybe it's midday, right? It's not in the morning anymore, then sure, scale out of half and then look for an extended target on the other half using all the various exit techniques that I've talked about. Okay, and just to show you midday congestion and how 1-to-1 would be fine for those, let me give you an example. Alright, this was the uptrend day that we had looked at before. And again, if you had gotten in here, which you should have been somewhere around 12.5 or maybe at this little retracement, you should just be holding. Now this type of day would have really needed patience because it ended up just going sideways almost all day long before then closing pretty much near the highs, and you would have just been holding it. But on other trades, for instance, if you had gotten long right here on this particular pullback that finally gave us a bit more than these tiny little ones, you see that we got this expansion right above the recent highs. Let's look at it real time. Okay, here it is real time. And if you had gotten in here at around 20, which I remember was a tick extreme, this would have been a great entry point. And your stop was, like we had said, somewhere 18 below this little mini volume node and this thrust up. So assuming it would have broken below those, and just a volatility stop to be wide enough. This thing at this point was reaching 2-to-1. So if you hadn't scaled out, which really in this situation you probably shouldn't because it's pretty decent high conviction odds that we're gonna go to make new highs before really pulling back much more. This would be a great time because you're having a mini volatility expansion here, range expansion. This bar is 1.25 points wide, which is wider than all the bars here except for this one. So, and it's just hitting the recent high of the day, just breaking out of. So those are usually good points. When you see this little thrust up, you get a tick extreme at it, just exit there. Okay. This was 2-1 though. But if you were entering midday, once this thing started forming a balance, let's take a look at that. Okay, as you see here, this thing kept drifting down. Eventually, this was just a massive balance. But let's assume that, we were retesting this previous extreme right here. Okay, and now we were hitting another tick extreme and we wanted to take another long right here, which would have been a logical place. And now it's, the thrust is coming down at 19.5, which is probably where the extreme would have been hitting. Another 2-point stop. Okay, we're far enough away at 17.5 or so. Well, it makes sense here. This is high odds enough that even if you were only shooting for a little quick up move back to the middle of the balance, a 2-point winner, it would have made sense. In this instance, it didn't really give it to you quickly enough. It just sat there moving for probably over an hour without even giving you your 2-point winner, and you would have had to sit through this. But here you would have got it. And maybe, by this point, enough time had passed that you think now, coming into the afternoon session, we might go to make new highs. Maybe you take a scale out at 1-1 and you hold the rest. There's no right answer. My point is that these are the kind of trades where midday you're seeing this thing kind of just drifting, coming back to support, bottom of the developing balance. You take it, and even if it's only 1-1 scale out, that's okay. And then maybe you shoot for the rest to new highs, which eventually actually happened here. You see it came back down and then shot up to new highs. So it wouldn't have been easy. And that's why a lot of these times when you're taking these type of trades, midday balance type trades, you would take them at one extreme and either just take the 1-1s, those almost sure little ones where after you hit an extreme you get a quick reaction back, or you scale out at those and look to scale out at either at the other extreme of the balance, or if we're now late in the day, for one final thrust through it, like this one. Personal preference, but just thought I'd show different ways of exiting there. And there you have it. Those are your exits for trend days. The core position you look to hold as long as possible into the close. The other ones you basically use the normal exit techniques that you've already learned, with the caveat that you can often shoot for smaller reward to risks because there's such one-way directional conviction that the accuracy becomes higher if you're picking the correct points. All right, so these exit principles, these exit rules should serve you well when trading trend days, and you just got to condition your mind to follow that correctly. That's really what trading is all about.